It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. Asian stocks paring gains as traders weigh whether Fed rate cuts this year are still on the cards. Australia's Reserve Bank looking set for a hawkish hold when it makes its policy call next hour. Also ahead, President Xi Jinping meets Emmanuel Macron in Paris, calling on his French counterpart to help fend off a new Cold War. Plus, we speak with global hospitality group Minor about their growth ambitions with a focus on India. CEO Dilip Rajakaria joining us exclusively later this hour. Now, let's get you to markets. Avril Hong on top of all the action. And Avril, equities, well, we thought it was roaring ahead, taking a backseat right now.
Yeah, a bit of that optimism fading as the session progresses. It started the day buoyant thanks to the performance of the S&P 500 on its best 3-day advance since November, moving past its 50-day moving average. And of course, this is fueled by Fed optimism. We also got a bit of that tailwind for sentiment thanks to the Shenzhen home buying restriction curbs being relaxed a little bit. But we've seen in the session how the Chinese stocks have been swinging between gains and losses, although Japanese stocks have returned from that long weekend, and that optimism and state of play seems to still be boosting these stocks in the country. Now, we've been keeping a close watch on dollar yen. Let's dig a bit further into that and flip the board, because we're seeing it moving back to levels that we last saw on Thursday. Of course, we've been working off the assumption that there were 2 rounds of intervention last week, and we also have that level coming through roughly at 154, despite that verbal intervention coming through from the currency chief. We've been focusing as well on the Aussie, as we'll hear from the RBA in the next hour. Let's flip the board and take a look at how traders have been bracing for a hawkish central bank. But we did get retail sales numbers that fell more than expected today, and that Aussie consolidation is in play here. We also have our MLive colleagues pointing out that the risks for the Aussie are for the downside. That is if the RBA follows in the footsteps of the Fed and signals no rate hikes this year, Has.
That's right. Expected to stand pad rates at 12-year highs. Avril Hong, thank you so much for that. Let's talk about the outlook for the Fed rate cuts. It is a hot topic at the Milken Institute Global Conference in Beverly Hills. Citadel CEO Ken Griffin and the New York Fed president among those weighing in.
If they haven't cut in September, they're likely to cut in December. Again, there's still a question of, will inflation actually decelerate enough by then? Wage growth sticky, core inflation sticky, deglobalization happening. That takes away from the constant deflationary trend that has helped the pricing of goods for frankly most of our adult lifetime.
For me, it's really looking at the totality of the data, not just looking at an employment report or a CPI or other piece of information. You really want to make sure we're looking at the broad picture. We have the maximum employment and price stability goal. So we want to, from my perspective, see all the data and information speaks to all of that. And really, as the data, come in, hopefully we'll be moving in the direction we want to see, both on inflation and in terms of restoring balance to the economy. And then we'll make our decisions based on that.
Well, our next guest believes there is reason for 2 Fed rate cuts this year. Let's bring in Eugenia Victorino, head of Asia strategy at SEB. We heard from Williams, Eugenia, that we have to take a look at the totality of the data. And when you take a look at that, it does seem like you can't support the 2 that you're looking at.
Well, in my view, you still have a lot of time before September. So our base case is that the Fed would actually start cutting by September and possibly another round in December. But the point here is they're not also guiding the market to expect a hike. So they're as hawkish as that as can be. So the next question is, if they're not hawkish, who's going to be dovish? Because we're not going to be seeing any changes from the Fed, at least until they're ready to guide the market. So we're looking more of moves in the market driven by other central banks, like the ECB, for instance. So in that scenario, the dollar strength would likely continue beyond Q3 and possibly only see the long-awaited decline of the dollar by Q4.
We know that the NFB revived hope of those rate cuts. But the thing is, it was only just slightly weaker. And if it's a Fed that is data dependent, it possibly needs about 3 months or 3 reports, which are weaker than anticipated.
Indeed. So actually, beyond the headline of the NFP, if you take out the main contributors of the NFP, which is basically government and education and health, the addition to the NFP of the other industries are actually declining, which is already telling you that there is some easing in the labor market. So if that just continues, even if it doesn't fall off the cliff, and we don't want that to happen, that should actually open the space for the Fed to cut later this year.
You talked about divergence in policy. How do you play that? You mentioned the ECB. Others in Asia might be doing the same.
Well, in Asia-Pac, we are expecting that the RBA, as you said, will be having their meeting later this afternoon. So we're actually expecting the RBA to be a bit more hawkish and reverse what they had communicated in March. But as for the other central banks in the region, I would expect that the other central banks would actually be delaying their cuts because they can't afford to see their currencies declining even more in the face of very strong dollar.
So here we're talking about Indonesia, Thailand.
Exactly, yeah. So even if the inflation picture in these countries are already suggesting that there is room to cut, the fact is their currencies are saying there is no room to cut at this point.
So you're talking about an RBA that's likely to sound hawkish. What are the chances of a rate hike by the RBA, given that, inflation remains really sticky and employment is also strong?
Yes, indeed. So actually, the reason why you have the strength in the Australian economy is despite the fact that you have a very high interest rates and consumer is somewhat getting hit by the high interest rates. The fact is business confidence remains high. And as long as your business confidence is high, then the likelihood is that the labor market will remain tight. But in my view, where the interest rates are, it's enough to lower the inflation. We've already seen some decline in the inflation, just not as fast as the RBA would like to see.
How do you play the Aussie? Bearing in mind as well that when it comes to Australia, it is also contingent, pretty reliant on how China is doing.
Exactly. So while the policy divergence is going to be supportive of the Aussie, the fact is the other drivers of the Aussie have not been contributing to the Aussie as much. So in fact, I would expect further upside to the Aussie, considering how high the iron ore prices have already gone. The fact is, at this point, the somewhat reluctance of the market to buy the China recovery story is dampening the upside to the Aussie. But, data is already showing that the China economy is improving. Taking out the property sector, there is an improvement in the business sentiment, so that should be supportive of the Aussie. You just need to be very careful of the levels that you buy the Aussie.
So what levels?
So right now, you're very near the year-to-date high, so maybe you can wait for declines, or you just need to be patient, because at 66.70, it's very difficult to go long at this point. Probably maybe at 65, 66, then you can continue further upside. Then the policy divergence would be in your favor.
Of course, we have to talk about the yen, front and center for FX traders. We know, there's suspicion there were 2 interventions recently. Your thoughts on where it is headed versus the USD, bearing in mind, of course, we've seen dollar exceptionalism for a very long time. That may, though, taper in 2025.
Indeed. So our short-term fair value suggests that the yen should actually be trading at around 153. Today we're above 154 now that the Japanese traders are back online. And the truth is the carry trade is just too attractive. But if you look at the fundamentals, which is basically the rate differential between the US and Japan, then it doesn't support further upside from here. But when you're talking about traders being excited, they can easily push it to 158. But at 158, the market should be very, very wary of renewed intervention.
And in terms of yen peak, what's the strongest yen level do you see out there?
Well, we've seen 160. Then unless the MOF suggests that they're willing to intervene again, the market can push it beyond 160.
And where are we in terms of the Indian rupee? Because that's been well supported by the RBI, not going anywhere, wants stability for the currency.
Well, the RBI is definitely, the BI, the RBI, yes. Okay, so too many currencies at this point. So the RBI is actually one of the currencies that has had very little volatility in comparison to the other currencies in the region. If anything, there's no volatility, even if you look at Indian rupee by itself. They've basically killed off the volatility. But you see, the flows, the structural flows are just too supportive of the rupee. But if you have continued strength in the dollar, then it's very difficult to see that the Indian rupee would appreciate from here. But it isn't necessarily going to depreciate as well because, as I said, the structural flows are just too strong.
When it comes to the Indian election, we're into the final phase and Modi is expected to serve another term. Will that make a difference to the strength of the Indian rupee, given that continuity in policies is expected?
Well, continuity in policy would definitely be supportive of foreign portfolio flows as well as foreign direct investments, because that's really the issue here, right? Like if there are any changes or if there would even be divergence in the state policies, that would be very detrimental to foreign direct investments. So any continuity in politics would be supportive of the rupee.
Eugenia, thanks so much for your thoughts today. Eugenia Victorino, Head of Asia Strategy at SEB. Still ahead, global hospitality group Minor Hotels betting big on India as it targets 50 new openings in the next decade. The CEO joins us for an exclusive interview later this hour. But first, Chinese President Xi Jinping continues his European visit. We'll tell you what topped the agenda during his meeting with the presidents of France and the European Commission. That is next. Keep it here with us. This is Bloomberg.
We discussed how to make real progress on market access. I remain confident that more progress can be achieved. At the same time, we stand ready to make full use of our trade defense instruments if this is necessary.
And that was European Commission President Ursula von der Leyen speaking during Chinese President Xi Jinping's visit to Paris. For more on Xi's trip to Europe, let's bring in our Asia government and economy correspondent, Rebecca Chung-Wilkins in Hong Kong. Rebecca, of course, Xi's first tour in Europe in 5 years. Beyond the symbolism, what's in there? What are some of the key takeaways from that trilateral meeting he had?
Well, that trilateral meeting, probably the sort of most awkward or the most potential to be awkward, because we have seen the EU increasingly move lockstep with the US when it comes to introducing this litany of probes into not just Chinese EVs, but other forms of the so-called 3 new drivers of growth, those clean tech areas, and investigating Beijing's state subsidies into supporting those industries. The EU has been very vocal on this point, particularly including von der Leyen, and China was very forthright in that meeting, point blank saying that China doesn't create an overcapacity problem. And there were these sort of tacit or oblique references perhaps to the US too. China urged that the continue not to trust or target any third party. The EU and China should work directly together, and that this shouldn't be dependent or dictated by any any third party too. So certainly a little bit of sort of tacit pushback, it seems, there between or on the influence that China sees the US having on EU policy.
Of course, Xi Jinping also calling on Macron to perhaps help to fend off a new Cold War. Xi also made some comments on the Middle East conflict. Take a listen.
Regarding the Palestinian-Israeli conflict, the delay of this tragedy to this day is a test of human conscience. The international community must do something. We call for an immediate, comprehensive, and sustainable ceasefire in Gaza. At the same time, support Palestine to become a full member state of the United Nations.
Rebecca, what do you make of Xi's statement?
Well, this is so interesting, I think, this context for Xi's trip, because on the one hand, China is there and Xi Jinping is there with a really big agenda of its own, which is to keep those trade barriers open with the EU and with European nations. But on the other hand, there have been these huge issues, not just the Middle East conflict, but also the issue of Russia's war in Ukraine that have come up. The huge sort of geopolitical landscape has really shifted underway. When it comes to the Middle East specifically, China has in the past historically sort of stepped up to try and act as something of a peace broker and to sort of legitimize its credentials on the world stage as a global actor. But it hasn't really weighed in particularly vocal over the recent issues. So I think although it's sort of Xi Jinping has tried to step into this role, by and large, he has sort of not leaned in too far. He's remained quite careful.
Rebecca, thank you so much for that. Our Asia government economy correspondent, Rebecca Chung-Wilkins. Now for an update on the Middle East. Israel's war cabinet has rejected a ceasefire proposal that Hamas had earlier accepted, saying the proposal falls far short of its demands. Israel has also promised to continue military operations in Rafah in the southern Gaza Strip. On Monday, Israeli forces warned civilians living in that area to leave, a possible prelude to a long-expected attack on the city where more than 1 million Palestinians have sought shelter. U.S. and Philippine Marines have conducted rare military drills on the Southeast Asian nation's northeastern inhabited island. Itbayat Island sits just about 160 kilometers south of Taiwan. The inclusion of Itbayat in this year's drills highlights the role that the Philippines could play in any potential China-U.S. conflict over Taiwan. The U.S. is adding a tank-destroying drone to an accelerated effort to prepare for a possible conflict with China. The Switchblade 600 is the first of a new wave of low-cost autonomous weapons. The Pentagon is publicly acknowledging its funding through its Replicator program. The weapon is known for helping Ukraine push back on Russian advances. Plenty more ahead. Keep it here with us. This is Bloomberg.
The Apollo program was something that was inspiring to everyone around the world. And we don't want the Apollo program to be the high watermark of human exploration. You want to have some sense that the future is going to be better than the past, that we're going to be out there, going to other star systems, and what you see in a science fiction, non-dystopian sci-fi story. I mean, AI might be the most important question of all. The percentage of intelligence that is biological, grows smaller with each passing month. Eventually, the percentage of intelligence that is biological will be less than 1%.
Tesla CEO Elon Musk speaking at the Milken Institute Global Conference in LA. Well, Musk touched on AI and a variety of other topics, from free speech to space travel to the existence of aliens, but avoided mentioning the EV maker. Well, staying with the conference, the IBM CEO says its AI unit has booked more than $1 billion worth of business already this year. Arvind Krishna spoke with us at the Milken Institute Global Conference in Beverly Hills about the regulatory landscape for AI and tech.
I think every regulator is worried about three topics, not just safety and regulation. They're worried about innovation, they're worried about competition, and they're worried about safety and regulation. So when you take those three together, the AI Alliance and Open really come together to help you foment innovation. So I think that actually helps the regulators to think about what is going on here. While I'll caution, there will be some guardrails that are always put, but in my experience, open technologies have always been safer and more secure than closed technologies.
Is one of the risks that maybe you're obviating with your emphasis on open architecture that some of the, I'll call them big guys, get an advantage and really have an entrenched position?
Well, I'll use the concept of a walled garden. When you have a walled garden, have those areas and technologies been more innovative or less innovative? I'll assert the walled garden has always been less innovative. And so I think that it actually helps you create more competition. Does it avoid regulatory lock-in of a certain one or two players? Likely, but isn't that good for all of us?
Are you pro-regulation?
I am pro-regulation as long as it is light touch and allows innovation to happen. I absolutely would be pro-regulation. If regulation tries to reduce innovation, I think that's a problem.
What about the distinction between regulating the technology as opposed to regulating the uses? We had Sam Palmisano, somebody you know well, on, who said he thinks regulate the uses, don't regulate the technology, because that will impair innovation.
Always. How can you regulate the technology when you don't even know where the technology can go? 2 years ago, who had heard of a large language model? If we come out with our technique called Instruct Lab, 6 months ago, nobody had heard of that. There will be another one and another one and another one. So I think trying to regulate a technology implies that the regulator and the policy folks believe no more innovation can happen. I think that's a bad bet to make.
And that was IBM CEO Arvind Krishnan speaking with Bloomberg's David Weston. And Amazon plans to spend $9 billion expanding its cloud computing infrastructure in Singapore. The outlay will be done over the next 4 years. The firm says the investment doubles Amazon Web Services investment in the Lion City and will accelerate the adoption of AI. In the markets, we're keeping an eye on China property plays. In particular, S&P saying that China property are looking for a bottom still. We're seeing China Vanke, Poly Property Group all in negative territory, reversing earlier gains. Times China Holdings down more than 4%. Logan Group down about 2%. We're also keeping an eye on those property plays because Shenzhen easing home buying to revive sales, but that's not helping sentiment. Of course, it says it will allow larger families to buy second units in some non-core districts. And Aussie assets in focus as well as we count down to the RBA decision. It is expected to stand pat for 4 meetings in a row, likely to keep rates at 12-year highs. The Aussie at 66.25 unchanged. The risk really is on the downside for the Aussie if the RBA sounds pretty dovish. Well, in the broader markets, Asia pretty much trending higher. It's looking for direction somewhat. Wall Street, of course, higher with the S&P coming off its best 3 days since November. There's optimism the Fed will start cutting interest rates. Take a look where we are in terms of the Kospi, up almost 2%, and we have the Hong Kong dollar unchanged. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. China markets just heading to launch. CSI 300 index in negative territory. We know that property plays are pretty much in the negative, reversing earlier gains with S&P saying that, you know what, property plays in China still looking for a bottom. CSI 300 index down 0.2%. Ain't too shabby. Remember that we've seen renewed optimism about China's economy. Beijing's latest policy stance supporting market sentiment along with super cheap valuations. In terms of the yuan, 721.79 is the level we're looking at. We're seeing dollar strength today, putting pressure on the Chinese currency, of course, well supported by the PBOC. Now let's do a check-in on how markets are faring with Avril Hong in the Lion City. Avril.
Yeah, Has, we are looking at Japan just about to return from the lunch break, and that's not all. They've also been returning from that long holiday, and of course, they're playing catch up today to that bout of Fed optimism and the run-up in U.S. stocks overnight. But of course, today, a bit of bucking the trend coming through from the likes of Sony. Its stock falling by the most in about 3 months after its proposal to buy Paramount Global is raising financing concerns. Those are among the stocks that we're watching today. But also this week, we'll be keeping an eye on the likes of Tokyo Electron as well as Toyota to see how the narratives of the weak yen and the AI boom for these respective companies are playing out and benefiting them. Let's take a look at how the Japanese currency is faring, because it has returned to weakness as traders focus on those yield differentials. That's despite what was likely 2 rounds of intervention last week. We're moving back towards the 155 handle on dollar yen. That's despite that verbal intervention coming through from the currency chief today that almost sounded like a challenge to more aggressive currency traders that they wouldn't need to intervene if the markets are orderly. Let's take a look at what's at play for the Reserve Bank of Australia. We'll hear from them in the next hour. And after that Q1 upside surprise to inflation, traders more or less bracing for a more hawkish central bank. Though, as our MLive colleagues have been pointing out, if they follow what the Fed has been signaling about no rate hikes this year, then we could see more downside risk for the Aussie, Has.
All right, we'll follow developments, of course. Avril Hong, thank you. For more on markets, let's bring in Bloomberg MLive Executive Editor Mark Cudmore. Let's start on the Fed. I mean, talk about being optimistic when, the data was only ever so slightly softer.
Yeah, look, 175,000 jobs added. It's still a lot of jobs being added. And look, last month we saw this dynamic of where an unemployment report saw treasuries rally, yields come lower. And then we had a hot CPI print and yields blasted higher, like way higher. So, look, we've got CPI coming next week. I think that there's a risk, that dynamic again. I think we're tactically due for a bit of a recovery in treasuries, and we're seeing that. I am still of the view that later on this year, there's a good chance we'll see yields go a chunk higher yet again. But I'm going to remain open-minded for the moment. I think at the moment, there's two-way risk. I'm not particularly excited either way.
So a lot more conviction is needed, right? I mean, we talk about how when it comes to a data-dependent Fed, it must be at least 3 prints which are softer than anticipated. Then only perhaps the Fed will consider its next move.
Yeah, and I think it's really important here. It's not just 3 prints softer than anticipated. I think it's actually soft prints, as in, just outright. Remember, we're still adding jobs just because it came in lower. It is true the unemployment rate picked up, and I think the wages were soft are important. But I think we got some other data. We got a soft headline ISM data, but the prices paid component was strong. We could be in a dynamic here where we actually do see the economy slow a little bit, which might see the Fed kind of go, look, we're definitely going to cut. It's just a timing issue. Maybe it's December, maybe it's next year, we're going to cut. That might cap the front end. But as long as prices are sticky, which we're seeing in all the ISM components, which we're seeing generally that sticky inflation, what we'll see is the curve steepen. And that will become a bit more of a dynamic. So I think that, rather than having a strong directional view on yields the next month or two, I think that the strong view I have at the moment is steepening of the curve. And I think we'll finally see this record long inverted curve finally end its inversion in the coming months.
Okay, the yen. We've been talking about the yen forever. Despite the 2 supposed interventions which we saw, the yen still didn't manage to get to 152.
Bearish the yen. I said to you that if the Bank of Japan came in and bought the yen, macro hedge funds around the world would be celebrating and high-fiving each other. It's just a chance to sell yen at better levels. It is fundamentally a currency which should continue to weaken, and that the dynamic's not changing. The BOJ have been helped much more than their intervention by the fact that yields have turned around, and that has changed the picture a little bit, but only at the margin. Overall, the story is you want to sell the yen. You may not want to sell the yen against the dollar. I think people should stop focusing on dollar yen, because I actually think dollar is turning. So I think dollar can become softer from here. I like the idea of being a bit more bearish the dollar from here. But the point is that yen you want to be short against the crosses.
Bearish dollar from here or towards tail end of the year?
I think, longer term, dollar over the next couple of years I think will go lower. I think that I've been looking for months for a turn in when you might want to become bearish the dollar for the longer term. I was wondering whether the Fed might be the catalyst. It's kind of provided that opportunity. I'm not 100% convinced this is the long-term turning point, but I think that, it's not going to go much higher from here. Maybe we get one more scare if yields go higher in the year. Overall, there's no upside to being bullish the dollar from here. But that does not mean you particularly want to be long the yen. So therefore, I think you got to still be bearish the yen on the crosses, and I think probably turning more neutral in the dollar, longer term bearish.
We heard from Canada yet again that there's no need to intervene if it's orderly. Is the FX market even listening to him?
I mean, they listen, but I think there's some comedy element to why you listen to these kind of statements. I don't think they're always listening to see if there's anything new. I think overall, as we've seen, this is kind of like providing a green light to kind of push the yen weaker again. Fundamentally, this is a country with deeply negative real yields, and yet an economy which is still not strong, and an economy which needs to import almost all its commodities in a world where commodities are strong and there's strong competition for those commodities. This is not a country that has a fundamental basis to have a strong currency. We might get to, we can argue, say, look, it's depreciated a long way. Fine, it has, but it's depreciated a long way for valid reasons. Maybe you don't want to be bearish yen anymore. Fine, I'm still bearish yen, but there's no reason to turn bullish the yen. I think that's really important.
So the yen level by the end of 2024 would be?
So I'm bearish the yen. I'm not bullish the dollar anymore, so I don't get excited about dollar yen. I think cross yen will be a chunk higher, and that's where I have conviction. If you're going to ask me to make a call in dollar yen, look, I still think we'll see dollar yen probably go above 160 again this year. Where it finishes the year, it might finish the lower only because we get a big dollar turn. But I said dollar yen's not the interesting play. Cross yen higher.
We shall keep track of your words. MLive Executive Editor Mark Cutmore there, here in Singapore. Well, more on criminal proceedings in Hong Kong now against Ganti Capital Management, the hedge fund's founder, Simon Sadler, and a former trader. The firm has long played a vital role helping Wall Street banks unload chunks of stock, dominating one of the market's lost old-school businesses. Hedge fund reporter Bei Hu joins us now. Bei, what is Ganti? Why is it in the news?
It's in the news because there was a SFC statement last week announcing it's initiated a criminal case against Ganti, its founder Simon Sadler, and a longtime trader for using inside information to trade.
Give us a sense of what a block trade is.
Block trade is actually a very loosely defined idea. It's basically someone unloading, a large chunk of shares in a listed company. It could be the company selling new shares itself. It could be a corporate insider. It could be an institutional investor selling. But the key point here is it's a privately negotiated transaction.
Talk to us about inside information. How is inside information shared before a block trade, and why is it problematic? What is the SFC doing about it?
Basically, in order to gauge investor interest in a block trade, banks and try to determine the right price level, banks oftentimes have to go out to a small group of investors before the deal, sharing certain information. Usually, the detailed deal information is not shared until the investor agree to be taken across the wall, which means signing a pledge to not act on that information until it becomes public. But even before that, banks have to give enough hint of what's happening, in order to get them to sign such a pledge. And that's where the problem begins, because oftentimes both the investors and the bank will have calendars of pending lockup ending, who may have shares to sell in a certain company. So the limited information that you share can actually help the investor guess who it is selling and how much, and act on that information.
Bei, thank you so much for that. Bloomberg hedge fund reporter Bei Hu, and of course you can get that story on the Bloomberg terminal. Still to come, our exclusive interview with the CEO of global hospitality group Minor Hotels. We discuss their India expansion plans. This is Bloomberg. back to Bloomberg Markets Asia. You're watching India Focus. We're counting down to the India Open in just under 3 minutes. We have futures pointing to a higher open. Sensex currently up by a tenth of 1%. Gains for the other benchmarks as well. Of course, when it comes to India, it's been the darling of investors, including its bond market as well. In fact, global funds have been piling into India's $1 trillion sovereign bond market ahead of the country's addition to the global debt indexes. So India pretty much front and center. Now, India's Prime Minister Narendra Modi has cast his vote as his national elections move to his home state of Gujarat. Is among 11 states and territories voting today as part of the third round of polling. Voting in India's marathon election will run through June 1st, with a count expected on June 4th. And global hospitality group Minor Hotels is set to intensify its presence in India. It's targeting 50 new openings within the next decade. The company says it plans to focus its strategy on the upscale and luxury hotel segments. Joining us exclusively, CEO Dilip Rajakaria. Dilip, good to have you with us. Give us a sense of what potential, quantify it for us when it comes to the Indian market.
Good morning, all. I think the Indian market has become very strong over the years. Especially, we see the luxury and the high-end segments has really taken off. And we see in our hotels outside India, because today we don't have a luxury. The Anantara brand is not in existence at the moment. We're hoping to open our first Anantara in India in July or August this year. But I think the Indian travelers outside India, or the outbound travelers, have been very, very strong for us. And therefore, we see a huge potential in the Indian market, sort of both outbound and inbound in the coming years.
But Dilip, quantify that for us in terms of India's contribution, perhaps 3 to 5 years down the road. How much would the Indian market contribute to revenue, for instance?
I think today we're hoping to have at least, the target is to get at least to 50 hotels in the next 10 years or maybe sooner, based on the growth trajectory we have at the moment. And the Indian market will account for at least about 20% of our annual revenues coming from this segment of the market in the coming years. Today, we see Indian market being one of the strongest markets, especially when it comes to weddings, functions, and also the luxury and the segments, the holidays as well.
You talk about filling the gaps, and by that you mean the luxury or the upper scale hotels. I'm just wondering, are you also looking at maybe, tier 2 cities and beyond?
Yes, we are. We have 8 brands today. So Anantara, which is our top-end luxury hotel, will be in tier 1 cities. And then we have the other brands. We have Avani's, we have NH, which is a European brand, which we acquired in 2018, and also NH Collections and Avani Plus, which will go into tier 2 and tier 3 hotels. We already have a hotel, which is Oaks, under our Oaks Hotels brand, in Bodh Gaya, in the north of India, in Bihar province. And our plan was to create a pilgrimage circuit around that, which is on target as well.
It is a tough market, though, Dilip. We have local brands, the likes of the Taj, for instance. How will you compete? What's your advantage?
I think our advantage is bringing a global brand, which has a very strong distribution globally. And also adding other elements to the experience as well, because the Anantara brand is all about, it's an experiential driven brand. It's all about guest experience. And that's where we excel compared to some of the other brands. And it's not a cookie cutter brand. Each of the hotels is curated based on the local culture, the local architecture, and bringing that concept into the hotel as well, and adding other concepts like wellness, other experiences. F&B, food and beverage, is also one of our key focus as well. So we bring a holistic solution so that the guests can actually enjoy and experience the luxury end of the brand as well.
How are you doing so far? Talk to us about occupancy and the kind of growth you're anticipating.
So far, last year was a record year for us at Miner International. This year is trailing better than last year. So our occupancies are around 65 to 70%. But what we have seen is a massive rate growth. And mainly it's to eradicate or offset some of the other challenges we are facing, like inflation, cost of labor increasing, interest rates going up, and all this. So we have focused on the high-end, top-end quality travelers and focusing on the rates. And therefore, we've seen a very strong year this year.
You've opened an office in Bengaluru as part of the expansion plans. Any plans to perhaps open more offices? And what are you doing in terms of hiring?
Yes, so we've already hired a VP for operations, and we are now planning to beef up our local presence in the market. We already have about 5 or 6 GSOs or general sales agents who are looking after the outbound traffic. And our plan is to enhance this both on inbound and outbound. So the next is we will beef up on the commercial side, on the human resource side, and also on the tech services or planning side as well, so that we can actually be providing on-the-ground experience and be close to the owners as well.
Dilip, of course, Miner is a global brand. It is pretty much headquartered in Thailand. Talk to us about how you're doing in Thailand and the rest of Asia.
I think the rest of how we're doing, like we have, as I said, we've had a best year ever. Last year was our best year ever in the history of Miner. And this year, based on what we are seeing, Q1 is going to be better than Q1 last year as well. So we are seeing a very strong growth, especially coming out of Europe. Europe is normally Q1 is always been a soft quarter, but this year it's come up as a very strong quarter. So we hope that this will continue for the rest of the year. And this year we should be beating last year's numbers and making another record in terms of comparing us to some of the other global brands as well, in terms of growth, in terms of pipeline, in terms of some of the rebrandings we have done and some of the new countries we have entered into as well.
What are the plans for the Thai market? I'm just wondering, because this is on the back of a backdrop where there is conflict between the government as well as the Bank of Thailand, and that has hurt investor sentiment. How are you looking at the situation and your own plans for Thailand?
I think Thailand is our home base, so we continue to be bullish about Thailand in spite of some of the external challenges we are facing. But I think I would hope these are temporary measures, and we take a long-term view, and we continue to invest in Thailand. We have quite a few projects coming in Thailand, including some of the high-end luxury residences, which we are doing under the Anantara brand, which also continues to grow quite strongly. We've signed many hotels in Thailand, and therefore we see Thailand as a very strong market because from a tourism perspective, Thailand will be one of the top 5 tourist destinations, and the government is really promoting the tourism drive in terms of really bringing this destination up to the global market.
Dilip, do you think Thailand needs a rate cut to boost the economy as suggested by the government?
Well, I think it's a monetary policy which the government needs. The thing is, there is pros and cons, because if there is a rate cut, then of course the interest rates become cheaper, and the currency, the investors tend to leave the country as well. But if their interest rates go up, the investors tend to move in, and the money flow actually comes into Thailand. But from our perspective, we have actually insulated ourselves in terms of the rate, which is there at the moment. We operate in more challenging countries compared to Thailand. Like we operate in Argentina, we operate in Cuba and other places as well. So we're quite used to navigating around the monetary policies of each of the countries as well.
Right. Dilip, thank you so much for your time today. Dilip Rajakaria, CEO of Minor Hotels. And we have some headlines to tell you about. Logan said to be mulling a new local bond restructuring plan. The firm is asking for a new grace period for yuan bond payments. Logan, of course, won credit support to extend its local bonds in 2022. Again, Chinese builder Logan mulling a new local bond restructuring plan is asking for a new grace period for yuan bond payments. Plenty more ahead. Keep it here with us. This is Bloomberg.
Clearly, there is some stress on the economy. I mean, that's to be expected given the interest rate rises, cost of living pressures, etc. So the market is subdued, particularly here, in Australia and New Zealand, and we see that, with more customers struggling. Although the number of customers struggling is still, from an historic point of view, relatively low.
And that was ANZ CEO Shane Elliott giving us his assessment of the Australian economy after the bank's first half cash profit fell 7% and announced a 2 billion Aussie dollar buyback. Remember, of course, the RBA is out with its decision at 12:30. Taking a look where we are in terms of the benchmark in Australia, ASX 200 index up 0.8%. The Aussie pretty flat right now, 66.28. Some say that if the RBA sounds less than hawkish, it will tilt to the lower side. 66.28, of course, a day when the dollar is actually trading higher. The RBA is seen delivering a hawkish hold, rates at 12-year highs. Overall, and of course, you can also turn to your Bloomberg for more on the rate decision. Go to TLive Go to get commentary analysis from Bloomberg's expert editors. And in terms of the broader market, this is how it's looking. Asia trending higher, pretty much in line with what we saw on Wall Street overnight on expectations. Perhaps the Fed will still cut rates this year. Front and center, of course, the yen currently down 0.4%. 154 is the level we're looking at despite two interventions that we've been talking about. That is it from Bloomberg Markets Asia. Horizons, Middle East and Africa is next. This is Bloomberg.